Salute, folks. It's your boy, the insurance junkie, your fiduciary fella, the all-star advisor Alonzo Hall, your social media insurance broker, back again today to whap and tap on your head with yet another ADH wealth solution. Today, we're going to be continuing to look at this IUL illustration, comparing it to an amortization schedule, and showing that people who are pushing you towards only term life insurance or telling you that an IUL is particularly a bad product may be doing so for one reason or another, but there are reasons for both things. Before I continue, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth or to schedule an appointment with a licensed financial professional, the links are in the description of this video. So, again, like I said, this particular IULs are not inexpensive. This one is $48,000 a year. If I do the math here, let's pull up my calculator. 1 second. Let's do the math here. 48,000 divided by 12. That means he's paying about $4,000 a month onto this policy. Now, again, a lot of agents set these up to be very beneficial for them. Often you can see, and like you can see, this is presented by me here, June 7th, 2023. In the last video, I showed you guys the amortization schedule, but we'll show that to you guys again. Hold on. All right. So, like I said, I showed you guys here from June of 2023 to June of 2053. That's a 30-year mortgage, right? So we're going to look at 30 years, right? And that life insurance policy. Now here, his monthly payment is almost $14,000. And, it showed you the breakdown of the amortization schedule. And it showed that he ended up paying $2.4 million in total in interest, which means that he ended up paying over $4 million for this $2 million loan. Now, he's going to use the buy, borrow, die strategy. So they tell you, well, don't borrow from the cash value life insurance. It's terrible. Well, why not? Because all he'd be doing, especially when you're looking at arbitration or a law called AG 49, you see, when you borrow from your life insurance, the cash value comes from here, your surrender value, but your account value stays remaining the same. So what happens is, let's say, the first 10 years, no. There has to be, again, this is a time horizon thing. So we know that his time horizon is going to be at least 21 years before he's looking to actually touch the money. Now, anytime between, he can actually touch the money, or instead of touching the money, you use your policy as collateral. So you use the death benefit to go obtain a loan. And then over time, you'll have the cash liquidity in here to take from this to pay off the loan instead of paying interest to whatever bank, and start paying it to yourself. But again, over 21 years, because remember, here, at the course of 20 years, he's paid in $960,000. But he's broken even, more than broken even, because he's up $26,000 here. He's $986,000 worth of cash value or cash surrender value. Over the course of 21 years, he's paid $1,008,000 into the policy. He's got access at year 21 to $1,058,000. Right? Now, again, this policy, like I said, in complete transparency, myself and the client had the conversation. He didn't mind this particular policy being set up to pay me handsomely because we've got other policies together, totaling a minimum of at least $100,000 a year that he's paying into multiple life insurance policies. Now, this person is also a business owner, so this is also a way to do tax efficiency. Again, the IUL is a very specific product and for a very specific client. It's very dangerous for a lot of agents to come out and do these for clients because they're just getting big checks. But let's continue. So what he's doing is something called the buy, borrow, die strategy. So at a certain point, he's going to start borrowing from this life insurance policy. Let's just say at 66, he starts borrowing from this life insurance policy. Now, mind you, let's say he borrows $48,000 a year from the policy, right? Well, the cash value is going to continue to grow. Now, if you'll see, yes, the cost of insurance does increase, and it does eventually eat away at the cash value of the policy. But again, just like they're explaining to you with your investments, eventually you want to start to liquidate them. So just like this, there's a certain point where you do want to start liquidating. So usually, let's see, where are we looking at where he wants to start liquidating? At about, what is this, year 1.179. So he's going to be at age 72, which is year 28 of the policy. He's going to want to start liquidating and buy, borrow, die. So he's going to want to start borrowing from this life insurance policy, let's say $48,000 a year. He can borrow more, but I'm just using it for, again, round figures. He can borrow and borrow and borrow, and as he continues and the cash value decreases, it doesn't particularly matter because the death benefit is still there. And now, because he's ballooned the death benefit so much, should he pass, his family would still get a death benefit. And again, this is just like an amortization schedule. Now, this particular one is the illustration. It's only hypothetical value because this particular illustration is, as you'll see here, not a contract because these are hypothetical values because this was the illustration. It becomes a contract once you actually purchase the policy and they add this to your policy. You'll no longer see the illustration. But I didn't want to show you his actual policy for the sake of, keeping anonymity of my clients. Also, shout out to a CFP who mentioned that the insurance company may not be able to come defend themselves. So I sanitized the insurance carrier's name, but as you'll see here, it says of New York because the state of New York has specific rules when it comes to their clients. As you'll see here, male, age 44 is his issue age, but that's why it says end of year 1, so on and so forth. So he's going to be paying for this policy for 21 years. Now, the wealthy think in terms of decades, not days. So, again, 30 years, right? So, 10, 20, 30, right? Because if he bought that house, that's where he's at 30 years. Well, at 30 years, putting $48,000, because he's basically done that in what? 3 months? Or, I'm sorry, 4 months, paying that mortgage of $14,000 a month. Or save himself $10,000 a month. And then at a certain point, use this as collateral to get that mortgage. Watch this, ladies and gentlemen. Can life insurance qualify you for a mortgage? So, if you have a life insurance policy, it could help you buy a house in a couple of ways. Lenders may accept your policy as a form of collateral. By putting up your life insurance, you can improve your chances of qualifying for a mortgage and at a lower interest rate. So, when you're looking at things like this, again, that's one of those strategies. We're going to have to do another part of this. That's going to be it for today, ladies and gentlemen. Wipe ass. Work in progress every day and see success. And remember, when people challenge you, they don't challenge you to challenge you, but they challenge you to challenge you. Accept the challenge. Salute.